Now we'll be discussing an important topic, and it is going to talk about closing your positions in the futures market. Now, buying and selling of futures contract happens on the exchange, and it is very similar to buying and selling of equity shares. So if you're buying in the morning, let's say an equity share that is having a value of 500, around mid afternoon it goes up to 600, you can immediately sell it, book your profit of 100. No need to take delivery. It's more like an intraday trade where you're going to buy today and sell today itself, and you're going to book a profit. You can do a similar thing in futures contract as well. So let's see an example. Mr. A is buying one March Nifty futures contract at 18,000 around 10 a.m. and he sees that around 2 p.m. the price of the futures contract has gone up to 18,050. So he can sell his futures contract and he can book a profit of 50 per contract multiplied by the lot size of 50. That means he can make a profit of total 2,500. So what he has done over here is around 10 a.m. in the morning, he has taken a long position, and around 2 p.m. in the afternoon, he has taken a short position. Now the futures contract is going to expire in March, so it is the same futures contract, only the price is different. So if I'm taking a long position and if I'm taking a short position in the same contract, my position is closed and I have booked a profit of 50 multiplied by 50, which is 2,500. Also, you need to know one thing, because this is an intraday trade, the mark to market will not happen over here. So M to M will not happen in this situation because the position is closed intraday. Let's see more examples. Now, Mr. B sells one March Nifty futures contract at 18,000 around 11 a.m. and around 3 p.m. the price of the futures contract has gone down to 17,920. So he's selling in the morning at 18,000 and around before the market closes, he's seeing that the prices have come down to 17,920. He can close his position by taking a reverse position. So he has taken a short position in the morning. In order to close his position and book his profits, he has to take a long position. So he has taken a sell position in the morning. He has to take a buy position in the afternoon in order to close his position. So he's selling at 18,000. He's going to close his position, or he's going to go long, or he's going to buy at 17,920. So he's making a profit of 80 multiplied by 50 is a lot size. His intraday profit is 4,000. So this is also an intraday transaction. This is also the March expiry futures. This is also the March expiry futures. The mark to market will not happen here as well. So example number 3, at 10 a.m. somebody is taking a long position in the March futures at 18,000, and at 11 a.m. the same person is taking a short position but in April futures. Now over here the contracts are different. The prices are also different, but the contracts are also different. He's taking a long position, he's taking a short position, but this is a March contract, this is an April contract, so the position is not closed. In this situation, there is no calculation of profit and loss. So he is having two position. He is having a long position in the March futures contract, and he is having a second position, that is a short position in the April futures contract. The position is not closed even though he is long in one contract and short in another contract. The position is closed only when this is also the March futures and this will also be the March futures. But that is not the case. So in this situation, the mark to market is going to happen. It will happen on this position as well as on this position. I hope you are able to distinguish between when the position is closed, when it is not closed. One more example. 11 a.m. somebody is taking a short position in the March futures. He is also taking a long position, but over here he is taking it in the April futures. Here also the position is not closed. M to M is going to happen here, and marking to market will happen here as well. So there is no calculation of profit and loss in this situation. He is having two position. This is position number 1, positions number 2. Last example, at 10 a.m., somebody is taking a long position in the March futures contract, but he is going long on 5 contracts at 18,000. Around 2 p.m., he is taking a short position again in the March futures contract, but he is selling only 3 contracts. So over here, I am buying 5, but I am selling only 3. Okay, the prices have gone up, so obviously there is a profitable scenario. 3 positions are closed with a profit of 50 per contract multiplied by 50 lot size multiplied by 3 contracts. So total profit is 7,500. Two positions are still open and mark to market will happen on these two positions. So I've given you various situations under which you will be able to determine whether the position is closed or not, whether the marking to market will happen or not, and whether you should calculate profit and loss on an intraday basis or on a mark to market basis. So to summarize, in order to close your positions, you can go long initially. That means you can buy first and then you can go short on the same number of contracts expiring in the same month. So 5 contracts long, 5 contracts short, and the month is March, then your position is closed. But if you are going long on 5 contracts and going short on only 3 contracts, then 2 contracts are still remaining. Also, the expiry month should be the same. You can also go short initially and then you can go long. So sell first, buy later on. Again, the condition has to be the same number of contracts, and they need to expire in the same month. Next, we'll be understanding what we mean by saying that somebody is taking a naked position in futures. So if you're going long or if you're going short on any futures contract without having a position in the spot market or in the underlying asset, you are taking a naked position. For example, Mr. X, he is going short on one Reliance futures and it is having a lot size of 250. That is, he is promising to sell 250 shares of Reliance on a later date when the futures contract is going to mature. If he is not having the 250 shares of Reliance in his portfolio, he is taking a naked or a short position. Now, if you're promising to sell something in the future, you need to have the asset with you. Then only you will be able to sell it. Then only you will be able to deliver it. But if you do not have a position in the spot market or in the underlying asset, you are taking a naked position. In this case, Mr. X is taking a naked short position. If you're taking a naked long or a naked short position, you are exposed to a market risk. That means you are exposed to price risk. So if the price goes up, if the price comes down, you will be facing some kind of profit and loss. The next is taking a calendar spread position. Now in a calendar spread position, you are going to take two positions in the futures contract. The underlying is going to be the same, but the expiry months are going to be different. For example, you are going long on one maturity contract and you are going short on another maturity contract. For example, you go short in January futures contract and you go long in the February futures contract. So over here, you are long in one futures contract, the month is different. You are short in one futures contract, the month is different. So you're not closing your positions over here by taking two opposite side of the transaction because the expiry month is different. Now we have already covered this, what is contango and backwardation, only the terms are new. So contango is a market situation where the futures price is greater than the spot price. That means the futures are trading at a premium. In this situation, market participants are expecting that the spot price will go up in the future. So today it is 100, later on it is going to be 102. So market participants are expecting that the spot price of 100 will become 102 in the future. Backwardation is a situation in which the futures price is lower than the spot price. So futures are trading at a price of 98, but the spot price is 100. So if there is a backwardation situation, then market participants are expecting that the prices will fall in the near future. So today the spot price is 100. After some days, it is going to come down and it is going to become 98.